Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Hello, everyone. This is Harold Green of Bright Tree Financial Group, and it is time to stop doing what you hate. Hope you're having a fantastic day today. I'm doing pretty good. Just wanted to reach out with you and share a show, and just kind of let you know what's been going on. Normally, I don't like just trying to make up stuff to do a show. I tend to let life play out and then share with you out of life's experiences. That way it's more real. Before I try to sit down and come up with 50 different things I wanted to talk to you about, 50 different things why I think retirement planning is important, or 50 different strategies, all kinds of stuff you hear out there. And I feel like it's just too much stuff out there that really doesn't help you move the needle on what you're trying to accomplish. And so today I want to get into this show, and the title of it is No Matter What, You Must Invest. And no matter what, you must invest. I mean, you got to do something. You can't just sit there and save your way to retirement or save your way to something. You gotta put the money to work. And we're going to be talking about that. But my goal is to help you get from where you are today to where you want to be. And I always start off by talking about the 97-3. The 97-3. 97% of people will retire, but they won't have enough to live on. Only 3% will retire and have everything they need to live a phenomenal, fantastic, mind-blowing life experiencing retirement. And my question for you is this: 20 years from now, if not less, when you retire and you look at the picture of your life, have you created a retirement masterpiece or a disaster? What's it going to be? It's up to you to decide. And how you invest will determine that. Whether you have a masterpiece on your hands or you just have oh my God, what am I looking at here? This is insane. But I need to read a disclosure to you because we're going to be talking about investments, right? And this is very important. So here it is. Past performance is no guarantee of future results. All investments, including real estate, are speculative in nature and involve substantial risk of loss. We encourage our investors to invest carefully. We also encourage our investors to get personal advice from your personal investment advisor and to make independent investigations before acting on information that we or anybody else publish. If you want to see what my fees are, please go to the Bright Tree ADV at the bottom of our website, which is www.brightfg.com. And you can see a complete list of fees that I charge. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. All investments carry risk of loss. All investment decisions on an individual remain the responsibility of that individual. There is no guarantee that systems, indicators, or signals will result in profits or that they will not result in losses. All investors are advised to fully understand all risk associated with any kind of investing they choose to do. And for more information, you can check us out. So now when I get into my week / my thoughts, what's going in my head. And I've had some meetings up here in Las Vegas. I've had clients come up and meet with me and talk with me and, just kind of share and go through some stuff. And, we had a really good time. I enjoyed it. Just like when I go back to Hawaii and I see clients and we go out to dinner, lunch, or whatever, I enjoy that stuff. And from time to time, while I'm up here working, I often get confirmation as to why it was a solid decision to move my firm to Las Vegas. But honestly, when it came down to it, I had two choices. And I want you to hear me out on this. And I'm not trying to put anybody down or make fun of anybody or make light of anybody's situation or how they have their business set up or anything like that. But I could have charged my clients basically 1%, put them in a bunch of mutual funds, and then played golf 3 times a week to help numb the pain of regulatory expense and tax issues. It would allow me to get a decent night's sleep so I wouldn't have to wake up at 3:30 in the morning placing trades, following trends, and trying to max out strategy. Like when my clients are just sitting in mutual funds, we don't have to worry about that because that's the funds manager job. The only thing I would have to do is find the right funds that kind of outperform the S&P and call it a day, right? Because the way things were set up in Hawaii was very, very complicated in terms of running an investment firm. And guys who are due there, most of them, depending on how their firm is set up, they do not run strat. Like they don't do that, right? That's not how their firm is built. And that's okay, to each his own. The other option was to move my firm to a better situation to reduce the regulatory expense and tax issues. And this would put me in a different time zone, which would then allow me to start work at a decent time to make trades early in the morning and follow trends and help grow my clients' assets. And so we're quite pleased right now with where we are overall. And it's only been 2 months in the year. And I'm excited about that. We're making adjustments in our strat, and I'm excited about that too. So last week when I was meeting with a client, they told me that I only needed to get them 5 to 10% per year, and they'd be fine with that. And that's basically the mutual fund strategy because, that's what people are used to. And they don't, some people don't need to shoot for the moon. Right now he's up about 20% plus in the first 2 months of the year, if not more. And I asked him, I said, well, this is great. Could I sell everything to cash and then take the next 2 to 3 years off? Basically, bro, spot me for a while. Like we got 20%. We locked that in, man. We good. He laughed out of his mind and said, no, no. And it was just so funny. We both just like had a good time with it. And then I just kind of I went through some things I've gone through in my life and the reasons why I fight so hard. And then, at the end, I explained my purpose, for the greater good. And I've just begun to explain to him that his family is well taken care of. I mean, his kids won't ever run out of money. I mean, they're good. Like we've spotted the next 2 or 3 generations, like they're good. And so I said, because of that, now we got to look at something else. We got to look at protecting everything, protecting your future, but then also what about giving to the community? And I shared with him my big audacious goal of the things that I like to see done in Hawaii, because I've been there for so many years and I still go back there. I have a lot of clients there. And I said, I want to set something up and then it's going to be designed to do X, Y, Z, and it's going to help these communities and these people. And I told him what it was. And he just looked at me. He was like, wow, I never thought about anything like that. And I'm going to be sharing that goal with my clients as we just kind of talk and look at their future, because it's pretty exciting. So we're going to be talking about that and talking about how we can make a difference. And so I wanted to just kind of go through this and just share it with you. Are you ready? 1, 2, 3, let's get it. Now, there are different types of investing, but I want to talk about the main 2, because this is going to make a major difference in terms of what you have at the end of the day, like what your retirement picture is going to look like. And so there's 2 types of investing. There's either passive investing or there's active investing. And I'm not going to harp on this all day because it's really simple. And I just need to lay a foundation here for some future shows. And so here's where I'm coming from. Over the years, I've had the privilege of working with a lot of different types of people. I mean, lots of people. However, the most successful ones have 3 dominating traits that when you combine these 3 traits, it's unphenomenal. I'll share them with you at the end of the show. But also to a person, every single one of them, they follow some kind of system or some kind of strategy until A, it's super successful, or B, it's no longer producing satisfactory results. They don't just change strategy because they feel like it. One day I woke up and you know what, this investment strategy that I'm doing for my clients, I don't feel like it. I don't feel like it's working. I don't feel like this, this is what we ought to be doing. I don't feel based on what I read and based on what I don't feel. And I'm like, bro, and I'll kid you not. Last year, I got these phone calls about some, my strategy, what I was doing. And some of the phone calls were like, are you sure this is going to work? Are you sure? How can you be so sure? How do you know this? Do you have insider information? Like all of that kind of stuff. And I'm like, no, I just know. I just have this thing where I know, because if I'm not right about this trade, the alternative is going to be a disaster, not just like for our clients, but for people all over the world. So I based on the research that I've done and what I see, this has to work. It's going to have to work. Otherwise, it's going to be a complete disaster, and it's going to affect every single, for the most part, every single segment of the market in some kind of way, shape, or form. And this is just how like deep I studied this. And this is like just how deep I was committed to this. And so I loaded up personally on some of these positions, and I took some super aggressive, risky positions for myself. And then I took the same positions risk for my clients, but not to the level that I'm at, because as a fiduciary, I'm not allowed to put my clients in a situation where like I'm taking, like too much risk for them. Sometimes we do. It depends on them. They have to let me know that, right? And so, it just kind of all depends. And so, but for myself, I did that. And and I just got questioned on it. And one day I was like just kind of down on myself. And I said, God, look, man, this is what we had talked about. And he reminded me that, look, have confidence in your work, have confidence in what you're doing, because it's not like if you're right, in this situation, it's going to be when you are right. And so did I feel like just like making everybody's stuff more conservative so I didn't get all these crazy phone calls? Yeah, that's what I felt like. But based on their goals and things that they told me before, I said, look, I can't do that. I would be going back on my word. And I can't just bail out on this because they're not feeling up to it today, or they're having a bad day. Or don't let that filter over into the strat. We call it the strat. Don't let it bother the strat. Okay. Stick with the strat, keep pushing, keep working, and it'll change. And it did. And at some point, I'll share the results probably in another month or two, because then by then all the hype and all the stuff will have been like probably settled down. And I'll share the results of what we did and how it worked. Now, I started in this line of work like when I was 23 years old. And over the last few months, I've seen a lot. And I've sat down and I've assessed what's happening in today's financial society. And so there's some financial movements happening, and many people are getting caught up in them with no regard of what the actual outcomes will be. They're hoping that it works out, but as you've heard, hope is not a strategy. Can't tell you the number of times I've asked people during our initial interview a question like this, and it's like, what is it that you want me to do for you? Like, what are you here for? And the response is, well, I was hoping you could do this, or hoping you could help me plan this, or hoping that you could do this. And it's an honest answer, but when we dig deep down, we cannot simply like hope our way through life. And most of us don't. We plan. I was telling my good friend Marvin the other day, I said, you plan for things that are under your control, and then you pray for things that are out of your control. You pray about those things. Like you can just plan, and then for things you can't control, you have to pray that you just gotta like you can't do anything about that. It's out of your control. I write down control my controllables, and the things that I can't control, I know what to do. But when we don't plan, it's a form of taking the path of least resistance. And as I stated in a previous show, there's very little left on the path of least resistance, and at the end of it, it's mostly crumbs. Hence the title, no matter what, you have to invest, right? In something. So there's reasons for people doing passive investing. It's simple. Number one, risk tolerance. Some people, they don't have a high appetite for risk. And basically they just want the money somewhere and somebody managing it that they think they know what they're doing. And so they rather leave it to them. Number two, it's time horizon. Some of them have like these long time horizons where, 5 to 10% a year is pretty good. And if you get 5 to 10% over 30 years, I mean, that really adds up. And then also like simplification, they want like a simple strategy or something simple. So passive investing in mutual funds is like, it's like the easiest way to invest. Like if you don't do anything, just buy a one mutual fund or something. But of course, I already put the disclosure up front. So you got to read your prospectuses and all that stuff. And then the last thing it offers is like diversification, right? So now that can be a plus or minus, right? If you're sector investing, which like you're buying mutual funds in the tech sector and you 10 different mutual funds, but all 10 of them, their top holding is Nvidia. It's like, that's very little diversification. So we have these tools that analyze all the mutual funds, and it tells you like your top holding at what percent it is, and then you break it down and you look at that, right? So there's different ways you can do passive investments. You can buy and hold, right? Buy and hold mutual funds for the next 20 years, and that might work. It kind of depends on what's going on in the economy, whether we're going into a bull market, a bear market. And a lot of that is, with passive investing, like these guys, they don't, let's just say you buy a mutual fund, the Fidelity 500, whatever, they don't take you all to cash in a bear market. It doesn't work that way. If your mutual fund is going down and you like set your limits on it and say, hey, I don't want to lose no more than 10% of my mutual fund, then your mutual fund will automatically get sold out when it falls like to that 10% mark. So if you had $100,000 and you set it at 10%, your risk is like 10 grand. You're not going to lose any more than 10 grand. So you're going to get stopped out. We go into a bear market and it's just going to sit there. So you got to reinvest that money. They're not just going to reinvest it for you in your inside of your strategy. So again, you have to follow a system and build a system. You can do stocks in your passive investing. I know a client who's had stocks since he was 19 years old. And now this stock is worth so much money. It's stupid. He held it. He bought a good company, right? And then, like I said, mutual funds, index funds, those are a great way to passive invest, right? They have low fees. So like an expense ratio of like 0.5 or 0.7. A lot of them, like, because they work off of volume, they have billions and billions and billions of dollars that they manage. And so of course, they're not going to charge you 2% in that strategy because they're just simply following an investment theme that they build out in that prospectus, right? And that fund. And trust me, it takes a lot of work just to create a fund and get it approved by the SEC. It takes teams and teams and teams and teams and teams. Running a hedge fund, just that. If you want to start a hedge fund, it's going to cost you about $1 million in fees just to like set up your hedge fund. Like it will cost you a lot of money. Okay. I don't care what anybody tell you. It's going to cost you a lot of money. Right. And so the real question is, how well does the strategy work? So it kind of depends on the outcome that you want. Now, if you're looking for a simple return that runs a little under or matches the S&P 500, then this may be for you. However, you probably need 20 years or more for this to work out for your benefit based on what you buy. Now, here's where passive investing becomes extremely complicated. So we're going to run a scenario. You're putting 10% in your 401k, and you have it set to automatically rebalance every 6 months or so, 50-50 growth / value. So 50% growth, 50% value. Now, if we enter a bull market from a bear market and your tech starts to outperform your growth and you don't let it run, what happens, right? Your tech could grow to 70% of the portfolio, but because of the auto rebalance, it automatically takes you partially out of the game and you miss the run. This is one of the reasons why I did a podcast show, like 10 reasons why your 401k probably sucks. And this is just part of it. And this is what I've heard. Most people are not even like paying attention to it because they only look to see if the account is going up or going down. This is a huge 97% mistake, right? 3% versus 97%, a huge mistake. If you know how to go into your 401k and set limits on these positions, on these mutual funds so that they get stopped out, so you don't have to constantly rebalance them, then, I mean, you got the game won. And here's the thing. Most people are so busy just living their lives, this simply gets overlooked. Plus, the main goal was like simplification and diversification and like saving, quote unquote, saving for retirement. I don't like that word, saving for retirement, because when you buy stocks, you are not saving anything. You are investing. If you want to save, right, you buy CDs, treasuries, or whatever. They do have an element of risk, but the only real savings is your savings account or the checking account at the bank. And the common response I get is, I don't know how to like make the changes. And it's like, well, all you got to do is make a phone call and tell them what you want. And then it goes back to, I'm just so busy. I don't have time. I'm just so busy. I don't have time. Now, the same can be said about mutual funds and index funds. And my advice is this. If you are going to passive invest, find the best performing funds that hold positions that are rated outperform. Okay, and just let it run until it stops. Let the bull run until it stops. Let the pig run until it stops. You know what I mean? This is if you don't have time to manage or you really don't want to keep close tabs on it, right? I understand everybody's busy. I'm busy too. Now, the same can be said like if you buy and hold stocks, pick a theme, hold it, let it run until it doesn't. Then find a new theme. Somebody asked me like, what is theme investing? And I said, well, this is theme investing. Like, if you really want to understand it, it's a little bit complicated. Okay. And I may talk to you about like how I theme trade, but I'm not sure I'll do that yet. So let's look at active/aggressive, right? So we talked about passive, non-aggressive, and you can also do passive aggressive. I don't like that word passive aggressive, but it's out there. Now, active aggressive is basically everything I just said previously, but with someone else making the choices for you, but frequently. For me, this requires a bit of finesse. Outperforming the S&P constantly requires, understanding when one theme is about to end and another theme begins. And at the moment, there's trillions of dollars sitting in high yield savings mechanisms and CDs and just all kinds of stuff. And here's a question: when this theme ends, where should you be moving your money? Well, what's the theme? Well, the theme is we're not sure what the Feds are going to do. And we're not sure when they're going to start cutting interest rates. And until then, we're not sure what's going to happen in the market. So we're going to sit this massive amount of money into high yield cash positions. And companies are making gazillions of dollars in interest on these cash positions. They're not spending, some of them are not spending the money, hiring new people. I mean, they're making more money, a lot of money, I would say, in the interest side of their business, like earning interest on their accounts, than some maybe from actual revenue. I can't say that for sure, but it's a good chunk of their revenue, like the interest, right? And so what's going to cause this theme to end? Well, the Fed is going to cause this theme to end because they're going to start cutting rates. And who wants to be sitting in $1 trillion of cash earning like 1% or 2%? And do you move before it ends or after it ends? Like, how do you know? No one knows. There's a ton that goes into this, but the main thing is this: if you're investing for the max return possible, your risk appetite will have to be quite large. This will mean no simplification and no real diversification for short durations. I call it scoop and score. That's my phrase. I call it scoop and score. When the market is giving you certain returns or certain sectors are outperforming, like that's where you want to be until they're no longer outperforming, and then you rotate. Right? You scoop up all you can scoop, and then you run and you score. You cash that in and you rotate it somewhere else. It's called scoop and score. That's what I call it. Now, look, if you can figure this out over the next 5 months, you're probably going to do well investing. Again, investments do carry risk loss. But here's where things can go wrong. As I was meeting with a client that I've known for since 2012, we talked about deciphering, decoding the information that's put out in the media. You basically can't, because most media, they drive narratives and they create hype. They stare fee for ratings. It's like watching episodes of The Housewives and for information on like how to have a happy family. Girl, I'll tell you what. In conclusion, I say this: there's one predominant underlying reason why people choose to passively invest themselves. Just one that I see: fees. 4-letter word, fees, right? FEES, fees. And like I said, you guys can go look at my EDV and see what I charge. But here's the thing: whether active or passive, you got to determine the value you're going to get from either one. If you value doing your own thing, great. You could passive or active invest based on what it is you're trying to achieve in your time horizon and your risk appetite, right? That's cool. If you find value in hiring a professional to do it for you, like that's fine as well. But what I see a lot of, like many people are like discounting the value of hiring a professional just like due to misinformation in the world today. I mean, I'll put it to you like this: if you don't hire a professional that will just passively invest, don't do that. You can do that yourself. Don't hire somebody who's just going to like buy you a bunch of mutual funds and then like charge you fees for that. You can do that yourself. You can do some research and you can do that on your own. But here's what I'm going to like submit to you today. I want you to kind of test this out for yourself and see which one works best for you, because everybody is different, right? Everybody has different patient levels and stuff like that. So invest $100,000 in a mutual fund or several of them for 18 months, and then give like an active money manager, if they'll take it, $100,000 to invest for 18 months. starting at the same time. No, open up your accounts, put your money to work, have them put your money to work on the same day, coordinate your effort, because one day makes a big deal. The market can be up 5%. Certain funds can be up 5% in a day. Some funds can be up 15% in a day. The stocks, I'm sorry, not funds. It all depends. This way, no matter what happens, like you're both investing the same amount under the same market conditions. It's not like, well, I put this money to work, we was in a bear market, and he put this money to work, we were in a bull market, then we went to a bear market. Like, no, you will get to see how they perform and what they buy and trade versus like what you bought. And if their fee is 2%, that's like $2,000 or more. If they make you money, that's what you're going to pay them. Okay. And then you can compare that to what you're paying on the mutual funds and then just see which one does what. Now, here's the thing. Like if they understand when one theme ends and another begins, most likely they're going to outperform you every single time. Why? Because in active money management, you won't see your tech get sold off if tech is the theme due to like auto rebalance. That's like in your 401k. And if you're just holding your mutual funds, most likely you won't just sell them off too when things change, unless you get nervous and then like, oh my God, it went out. Oh, Microsoft went down like 15%. Boom, I'm out. Like, man, this is stupid. I'm losing money. I'm out. But then your guy, like the money manager, he holds it. And then the next thing you know, in the next year, it goes up 35, 40%, but you never got back in. All of this stuff happens. And mutual funds, they have certain parameters that they set that they can't see their holdings. And so if Microsoft is their top holding and Microsoft goes on a run, they start to trim it back because they may set Microsoft at like 2.3%. And then they may rebalance that portfolio every quarter. So you're going to have no more than 2.3% of Microsoft in your portfolio, right? It's strict discipline, good or bad. Now, I talked about the three main traits that most successful people have that I see. And number one, they're humble people. They're humble people. Like they're just so down to earth. And some of these people are worth millions and millions of dollars that I work with, but you won't know that. You would think they're just the average run of the mill person that don't have much, but because they don't live extravagant. It doesn't mean that they don't do extravagant things here and there. That's not what we're saying. Also, number two, they're diligent and they work hard. All of these people work hard. They have like this work ethic like you wouldn't believe. And then number three, they're coachable and they're moldable. And I had this client tell me this story about something that went down with them a long time ago, and it was a big deal. Where this person used to work, I mean, this place was a big deal. They had a lot of stuff going on, and I can't say exactly who they are or what they did, but they told me about a situation and they told me how it unfolded. And the way they resolved it was, even though they knew they were right, they humbled themselves and they went and said, look, I'm sorry. I was out of line and blah, and they fixed the situation, right? And one of the things he told me was, he says, Harold, like when I'm with you, I'm like putty in your hands. Okay. I hired you because that's what you do. And he has two other financial advisors besides me. I'm just one of the people managing some of the money. And that's fine, because the other advisors have their different things. And I have my thing. I have my strategy that I'm running for him. Okay. And he just says, you know what? I'm just going to leave it up to you because that's why I hire professionals to do what they do. I don't look over your shoulder. And I said, thank you very much. I appreciate that. And it's interesting because they understand what's needed to accomplish anything, whether it be like work related or like just life in general. And when I look across the board, these are the traits of the 3%, or the traits that lead people to be in the 3%. Now, some of these people are not born in the 3%. Most of them are not. They had to work their way to get there. Can people change once they get there? Yes, I've seen people change. And I believe that money simply amplifies what's already inside a person. And like, that's it. Now, I've seen people that are kind of born into money, and some of them are complete jerks because they have these high expectations. They feel like they're entitled. Like they grew up seeing like the best of everything. So like to not have the best is murder to them. Like, oh my God, you're killing me. I don't have the best. Oh my God. I could, I'm not saying you shouldn't enjoy the best. I'm just saying like life should not revolve around that. Like, so if you can implement these traits in your life and then figure out how to generate revenue for others and create value in the world, you're going to be quite successful. And so, passive or active, do your research, decide what's best for you, test out my theory, and it just may be the game changer that you need. But no matter what, you must invest. You can't sit on your hands and hope that you're going to create a masterpiece by sitting on your brushes. So get to work. Until next time, everybody, 1, 2, 3, let's get it.
This is the podcastfactory.com.